In this lecture, we are going to study enterprise value, equity value, and free cash flow. These ideas are at the center of corporate valuation. They appear in discounted cash flow models, merger analysis, stock valuation, private company valuation, and investment banking work. But before we start building formulas, we need to ask a very important question. What exactly are we valuing? Are we valuing the entire operating business? Are we valuing the value available to all capital providers? Are we valuing only the common shareholders' claim? Or are we valuing one specific security issued by the firm? These questions sound similar, but they are not the same. Each one requires the correct cash flow and the correct discount rate. This is the discipline of valuation consistency. Enterprise cash flows should be matched with an enterprise discount rate. Equity cash flows should be matched with an equity discount rate. Operating assets should not be mixed with non-operating assets without a clear adjustment. So today, our goal is simple. By the end of this lecture, you should understand what enterprise value means, what equity value means, how free cash flow connects them, and how to avoid the most common mistakes in valuation. Let's begin with enterprise value and equity value. Enterprise value represents the value of the firm's operating business. It is the value of the core operations before we decide how that business is financed. Think of it as the value of the productive engine of the company. Equity value, on the other hand, is the value that belongs to common shareholders after considering the claims of debt holders, preferred shareholders, and other senior claimants. It also reflects cash and other non-operating assets that ultimately belong to shareholders. This distinction is very important. Enterprise value and equity value are not competing answers. They answer different questions. Enterprise value asks, what is the operating business worth? Equity value asks, after all senior financial claims and non-operating assets are considered, what value is left for common shareholders? The bridge between enterprise value and equity value is one of the most important ideas in valuation. When we move from enterprise value to common equity value, we account for debt, preferred stock, non-controlling interest, cash, and non-operating assets. The logic is intuitive. Debt holders and other senior claimants have claims ahead of common shareholders. Cash and non-operating assets are usually separate from the operating business, so they are treated separately in the bridge. A clean valuation always knows which claim is being valued. Now, let's separate operating assets from financial and non-operating assets. Operating assets are the assets required to produce goods or services, serve customers, and maintain the firm's competitive position. These include items such as operating property, equipment, inventory, operating receivables, operating leases, working capital, technology, brands, customer relationships, and other assets that support the business model. These assets are part of the core operating enterprise. Financial assets and non-operating assets are different. They may be valuable, but they are not usually required to generate the operating cash flows we forecast in a discounted cash flow model. Examples include excess cash, marketable securities held for investment purposes, minority investments, unused land, assets held for sale, separable tax assets, or legal claims. Why does this matter? Because different assets can have different risk. A safe financial asset should not necessarily be valued using the same discount rate as a risky operating business. A clean valuation values the operating business first, then separately considers the value of non-operating assets when estimating equity value. This also explains why two companies can have similar operating businesses but different equity values. One may hold substantial cash. Another may carry substantial debt. The operating enterprise may look similar, but the shareholder claim can be very different. Let's talk about net debt and the enterprise to equity bridge. Net debt is a practical way to summarize financial claims that stand between the value of the operating business and the value available to common shareholders. It usually includes interest-bearing debt and debt-like obligations, reduced by excess cash and non-operating financial investments. Analysts often include short-term borrowings, long-term debt, capitalized lease obligations, and other commitments that behave economically like debt. But ordinary operating payables are usually not treated as debt. Why? Because they are already part of operating working capital and are already reflected in free cash flow. Cash requires judgment. A company needs some cash to operate safely. It needs cash for payroll, customer refunds, transaction processing, seasonal needs, and normal flexibility. Not all cash is excess cash. A useful question is this: could this cash or investment be distributed, used to repay debt, or sold without harming the forecasted operating cash flows? When the answer is yes, the asset is more likely to be non-operating. This is why valuation is not just mechanical. The analyst must understand the business. The same balance sheet item may be operating in one company and non-operating in another, depending on how the business actually works. Now we move from accounting statements to valuation cash flows. Financial statements give us the raw material for valuation, but accounting earnings are not the same as cash flow available to investors. A company may report strong accounting income while using a lot of cash. This can happen when customers have not yet paid, inventory is increasing, capital expenditures are heavy, or growth requires more working capital. The opposite can also happen. A company may report modest accounting income while generating strong cash flow because non-cash charges reduce reported earnings without using cash in the current period. So valuation requires adjustments. First, we focus on operating performance. For enterprise valuation, we begin with operating income rather than net income, because net income already includes financing effects. Second, we consider taxes on operating income. Third, we add back non-cash charges such as depreciation and amortization. Fourth, we subtract reinvestment. Businesses must invest in long-term operating assets and working capital to sustain and grow operations. Operating net working capital is about operating current assets and operating current liabilities. Cash, marketable securities, short-term debt, and the current portion of long-term debt are usually excluded because they are financial items, not operating items. This conversion is essential. Valuation is about future cash flows after the business funds the investment required to keep operating and growing. Let's focus now on free cash flow to the firm, or FCFF. FCFF is the cash flow generated by the operating business that is available to all providers of capital, after operating expenses, taxes on operating income, and required reinvestment. The key phrase is all providers of capital. FCFF belongs to the operating enterprise before we divide value among debt holders, preferred shareholders, and common shareholders. That is why FCFF is called a pre-financing cash flow. It is measured before interest payments, principal repayments, new borrowing, dividends, and share repurchases. This is powerful because it allows us to value the operating business independent of the current financing mix. We can ask, what is the business worth as a business, before thinking about how it is financed? When FCFF is used in a discounted cash flow model, it should be discounted at a rate appropriate for all operating capital providers. In standard corporate valuation, that rate is the weighted average cost of capital. The financing effects are not ignored. They are reflected in the discount rate, not inserted directly into FCFF. This is where many valuation mistakes begin. If we use an enterprise cash flow, we need an enterprise discount rate. If we use an equity cash flow, we need an equity discount rate. Consistency is the foundation. Now let's interpret FCFF economically. FCFF answers this question: how much cash did the operating business generate for all capital providers after funding the reinvestment required by the business? Each component has a meaning. Operating profit after tax represents business profitability before financing effects. Depreciation and amortization are added back because they reduced accounting income but did not directly use current period cash. Capital expenditures represent cash invested in long-term operating assets. Changes in operating working capital represent cash absorbed by the operating cycle. But high FCFF is not automatically good, and low FCFF is not automatically bad. A company can temporarily increase free cash flow by underinvesting, delaying supplier payments, cutting important research, or allowing inventory to fall below sustainable levels. That may improve short-term cash flow, but weaken the business. A growing firm may show low or even negative free cash flow because it is investing heavily in valuable opportunities. That may be perfectly reasonable if the investments earn returns above the required return. So the analyst should always ask, is this free cash flow sustainable? We must connect FCFF to competitive position, margins, reinvestment needs, growth opportunities, working capital discipline, and risk. Free cash flow is not just a number on a spreadsheet. It is a story about how the business makes money, reinvests, and creates value. Now let's turn to free cash flow to equity, or FCFE. FCFE is the cash flow available to common shareholders after operating expenses, taxes, required reinvestment, interest expense, debt repayments, new borrowing, and preferred dividends. Unlike FCFF, FCFE is after financing effects. It already reflects interest, debt policy, and other claims that come before common shareholders. This means FCFE is an equity cash flow. It should be discounted at the cost of equity, not at the weighted average cost of capital. FCFE is useful when the analyst is focused directly on common shareholders, especially when the firm's leverage policy is stable and reasonably predictable. But FCFE can be more difficult than it first appears. Because it depends on borrowing and debt repayments, the analyst must forecast financing policy, not only operating performance. It is also important to understand that FCFE is not the same as dividends. Dividends are cash actually paid to shareholders. FCFE is cash that could be paid to shareholders while preserving the operating plan and financing policy. A firm may retain FCFE to build cash, repay debt later, repurchase shares, make acquisitions, or preserve flexibility. So FCFE gives us a view of shareholder cash flow, but it must be interpreted carefully. It is influenced by both operating performance and financing decisions. So, when should we use FCFF and when should we use FCFE? Both are useful. They simply answer different questions. Use FCFF when the goal is to value the operating enterprise. It is especially useful when the company has changing capital structure, material debt, or when we want to compare firms with different leverage. FCFF is also common in acquisition analysis because a buyer may care about the value of the operating business regardless of how the seller currently finances it. Use FCFE when the goal is to value common equity directly and the firm's leverage policy is stable enough to forecast. FCFE can be useful when debt is closely connected to operations, although some industries, especially financial institutions, often require specialized approaches. The broader rule is simple. The cash flow must match the claim, and the discount rate must match the risk of that claim. FCFF is matched with enterprise value and an enterprise-level required return. FCFE is matched with common equity value and the cost of equity. Debt cash flows are matched with debt value and a debt-appropriate rate. Non-operating financial assets are valued using rates appropriate for their own risk. This same consistency applies to currency, inflation, taxes, and real versus nominal cash flows. A valuation model must tell one coherent economic story. Let's finish with managerial interpretation and common valuation mistakes. Enterprise value, equity value, FCFF and FCFE are not just technical definitions. They shape how managers and analysts interpret strategy, performance, and financing. Operating improvements affect enterprise value. Stronger revenue growth, better margins, more efficient asset use, and disciplined working capital management can increase operating free cash flow and therefore enterprise value. Financing choices affect how enterprise value is divided among claimants. More debt does not automatically make the operating business more valuable. It changes the financial claims on that business, and it may also introduce tax benefits, distress costs, and risk. Reinvestment creates value only when returns exceed required returns. Growth alone is not enough. A company can grow and still destroy value if it invests poorly. Cash balances also require judgment. Cash may provide flexibility and safety, or it may represent excess capital that could be returned to investors. The most common mistakes are mixing cash flows and discount rates, double counting cash, using book values when market values are more relevant, treating all cash as excess, ignoring debt-like obligations, confusing accounting earnings with free cash flow, and assuming growth automatically creates value. The solution is consistency. Begin with the valuation question. Identify the claim. Use the correct cash flow. Apply the correct discount rate. Then build a model that tells a clear economic story. Thank you for joining me today. I'll see you in the next video.